A scaling real estate brokerage often hits a specific, predictable wall. Right as a firm achieves record revenue, the back office begins to gridlock, and the unified financial ledger fragments into dozens of floating, disconnected spreadsheet grids. This creates a paradox for broker owners. The firm is profitable, yet administrative friction reaches a level that restricts the ability to expand. To understand why this happens, we have to look at the baseline architecture of generic accounting software. Tools like QuickBooks or Xero are built for linear business models. A product or service is sold, and revenue flows into a standard ledger. Real estate transactions rarely follow this path. They require multivariable accounting, where a single incoming revenue event must be divided among multiple stakeholders before the transaction is finalized. We are going to map exactly where generic ledgers structurally fail under this pressure, diagnose the hidden operational costs of those failures, and define the enterprise architecture required to support scale. When a growing brokerage feels this operational friction, it is rarely a staffing issue. It is a mathematical failure of the underlying software architecture. In early stages, generic accounting software functions as intended. Data is smoothly passed from the brokerage to a central general ledger. Low transaction volume and standardized revenue models map easily to standard ledgers. The back office handles straightforward splits without complex mid-transaction math. Because the operational variables remain low, a lean back office team can input this data manually. The manual work takes time, but it doesn't create a systemic bottleneck. This early-stage efficiency masks the fact that the generic ledger lacks the native capability to handle non-linear transaction logic as the roster grows. As a brokerage scales, competitive commission structures mean the general ledger is suddenly bombarded by erratic, branching variables. Multi-tier splits based on individual agent production introduce intense computational friction. The generic ledger cannot process this math. The system reaches a bottleneck and flashes an error. Standard corporate ledgers do not track agent-specific performance thresholds. They lack the native logic to hold agent data and apply conditional math to a transaction in real time. Adding multi-office operations multiplies this friction. When splits and caps vary by branch, the resulting profit and loss reporting becomes disjointed across the enterprise. Dynamic commissions replace a standard ledger entry with a series of fragmented computational tasks that generic software cannot solve. Internal revenue distribution is only part of the problem. The operational failure becomes critical when we look at the regulatory environment of escrow and trust accounting. Compliance requires earnest money deposits to be linked directly to individual, isolated transaction ledgers. Generic accounting platforms treat incoming escrow funds as standard cash flow. They lack the native, automated safeguards required to prevent the commingling of trust money with operating funds. To force compliance, back-office teams invent manual workarounds. They build custom tagging systems or rely on external spreadsheets to track which dollar belongs to which property. Using generic ledgers for escrow shifts the burden of state regulatory compliance entirely onto the manual execution of the accounting staff. To bridge the gap, brokerages build an ad hoc network of spreadsheets. Manual interventions occur exactly where generic software fails, at commission calculation and escrow transfer. Relying on manual entry here increases accounting errors. This gridlock delays the closing of books, making real-time reporting impossible. This is the hidden tax of legacy systems. The brokerage pays in lost administrative productivity and operational blindness. When multi-office P&L aggregation is delayed, broker owners lack the current data required to make agile decisions regarding enterprise cash flow. As these manual processes multiply, the cost of processing each new transaction increases. The brokerage is scaling its revenue, but it does so by disproportionately growing its administrative overhead. The structural solution requires migrating to an industry-specific operational ecosystem. In this architecture, the general ledger is protected by automated nodes, a commission engine, an escrow tracker, and a multi-office P&L aggregator. The native commission engine processes dynamic splits, royalty fees, and agent caps before the data ever reaches the ledger. The integrated escrow tracker natively isolates trust funds, maintaining regulatory compliance without manual tagging. Because this data flow is automated, brokerages can generate multi-office financial reports without manual spreadsheet exports. A real estate native ecosystem absorbs operational complexity. It protects the core ledger and eliminates the need for a manual spreadsheet bridge. This architectural shift reaches the agents on the front line. Fractured back-office architecture directly degrades the experience of the people generating the revenue. Disconnected systems leave agents blind to their production numbers, their progress toward caps, and their projected payout timelines. Integrated agent portals pull accurate data directly from the central accounting hub. Providing individual financial visibility reduces the daily volume of status inquiries and commission questions hitting the back office. Upgrading enterprise software reduces operational friction for both the accounting team and the sales force. Generic accounting software places a mathematical cap on a brokerage's ability to scale efficiently. Transitioning to a real estate native platform is a structural requirement for building a multi-million-dollar enterprise that remains manageable. We want to hear about your experience with this transition. At what agent count or transaction volume did your brokerage begin to feel the limits of your generic accounting software? Let us know in the comments.